The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Thank you for being here on this winter Monday night. This is Your Money, Your Call, and I have two of my regular guests here tonight to help me answer all of your questions. But before I introduce them to you, here's your property news for this week. And the Property Council of Australia has proposed to scrap stamp duty with a loss in state government's revenue recouped from an increase in the goods and services tax. In its submission to the federal government's tax white paper reform process, the council argues stamp duty is inefficient and nothing more than a runaway cash grab that's hurting Australia's economy and locking out potential home buyers. It's released figures showing the cost of stamp duty to a home buyer with an average size mortgage has increased by 795% in Melbourne and 749% in Sydney during the last 20 years. The council's chief executive, Ken Morrison, says that the community should be outraged that they're being slugged with such excessive charges, especially at a time when housing affordability is an acute challenge. And all future residential property developments in Sydney may be forced to include affordable housing for rental to key workers. Family and Community Services Minister Brad Hazzard has flagged. The soaring Sydney property market risks excluding many average wage earners, including police, nurses and teachers, from living in suburbs that they work in. The Baird government is developing a whole-of-government approach to affordable housing, with a policy expected to be prepared for Cabinet by the end of July. Mr Baird committed to a $1 billion affordable housing fund during the election campaign. Affordable housing refers to an asset class of properties subsidised by government for rental at 20% below market rates for that suburb to low or moderate income earners. Now, I'm sure that you have some opinions about those stories and some questions too for the panel. So let's welcome aboard Ben Kingsley from Empower Wealth and Michael Tees from Block Strata into the studio. And if you have a question for anyone on the panel this evening, don't wait. Call us right now on 1300 30 34 35 or email your question to me right now at property@skynews.com.au. Welcome to the program tonight, and let's get started. And welcome to you both.
Thank you, Margaret.
Let's start with our first story about the council saying that we need to get rid of stamp duties and replace it with goods and services tax. Of course, if anyone's had a really good examination of the way our goods and services tax works and our economy works, really we could solve a lot of problems by just going to a 15% GST. Michael?
Well, that's true, but it's just not going to happen.
No.
I mean, this press today and yesterday about this issue is just a waste of words. It's a waste of space. I mean, the states can't agree on what's the week it is, let alone how we're going to increase the GST. So I just can't see it happening. I think it's too big a part of state government's coffers, and they're not going to give it up.
Ben, they talk about the increase in stamp duty, 795% in Melbourne, 749% in Sydney. We need to stress to the viewers that this doesn't mean that the government has increased the rate of stamp duty by that amount. In fact, the rate of stamp duty hasn't increased at all. It's just that with the rising price of houses, then the amount they're collecting is what has increased.
Correct. There has been some slight adjustment to some of the tiers is the best use of word there, and I think from that point of view, but we have seen obviously indexation and inflation playing a part of that, but they're still big numbers. I mean, as the value of property rises, they collect greater revenues.
Yeah.
I thought it was a bit mischievous of Ken Morrison to release those numbers. You know, he's got a point, he's made his point, but those numbers were meant to be dramatic. They were meant to get a headline, and I think he may have shocked some people into misunderstanding his point. I thought it was a cheap shot.
They certainly did appear. I know when I saw the story on the news this morning, my immediate reaction was, hang on a minute, they haven't increased by that much. But when you worked it out, it was basically on the price, and I guess that's unfair. But, you know, Ben, I guess from my perspective, you know, there's a lot of things that can be done. We've got the negative gearing debate at the moment. Everybody's worried that it's going to be taken away. But I sat down and spent just 5 minutes, and I came up with 7 ways that we could actually assist affordability and assist first-home buyers getting into the market without removing negative gearing and making it a more level playing field. It's pretty much just, it requires just a bit of thought by the government.
Yeah, it does, and the majority of the problem's on the supply side. So, you know, I still take offence with, you know, what is it, 30 to 40% of total revenues for each state government is coming out of stamp duty. Now, that's a big kick. So what we obviously need to do is, I think at some point the GST has to be looked at. I mean, we haven't moved it since 1999 when it was first introduced. But coming back to the point, Margaret, about affordability, you're absolutely right. We get the supply side right, but I think Australia has to have an honest conversation with itself. Land is not in abundant supply in a city. We can't create more land. So the reality is Melbourne and Sydney are in the top 100 cities in the world in terms of, they're large cities. So we can't find any more of that land closer in. So unless we subdivide it or build medium density or high density on those particular things.
That's an excellent suggestion, Ken. I think more high density. I'm not opposed to the GST changing, by the way.
No.
What I'm saying is it's not going to happen. Politically, it's just not going to happen.
Yeah, no, exactly, it's not going to happen. Let's go to the second story very quickly. And the New South Wales government talking about affordable housing. Now, God forbid that there should be another NRAS scheme.
Well, we saw the failure of the first NRAS scheme in terms of the complexities around the ownership problems that we had with it. I think it's well and good to sort of talk about essential service people wanting to live closer to where they're working. I think that's, you know, we all encourage that, but there's got to be some smarter ways in which we can look at providing that affordable home and housing so we can see those people living in those areas.
Michael, when the first NRAS scheme came out, it was a good idea that was just used and abused by the spruikers who grabbed hold of it, began selling property with big commissions, overpriced, oversupplied. The whole thing ended up being a dreadful mess the tax office wasn't even ready for, because as far as they were concerned it was only large institutions who were meant to be in on the game, not the little investor.
You know,
it was a
look, over the 20 years since I did a subsidised rental housing scheme, you might recall, in Caboolture in the 90s, and you know, we've experimented with subsidies to developers, subsidies to tenants, and subsidies to landowners, and they always come with the potential for abuse, and they always come with a lot of baggage because government's very afraid of being seen to be benefiting, you know, rich landowners and rich developers. You almost come back to the position we were 30 years ago, where public housing is built and run by the state. Perhaps that's just the way it's got to be. I think we've learnt a lot about the way not to do it, and perhaps, you know, we could outsource some of that to private enterprise. But there's so many strings attached to government funding as it relates to ownership of property or the development of property, that it's hard to see it being any other way.
Well, if we get some time later on in the program, I'll pop out to you my 7 ideas that I came up with, and maybe we can have a discussion about them, and maybe we can solve the world's problems.
Maybe we should elect you to Parliament.
Well, look, I've thought about running for Parliament, but everybody looks older than they are in the first 5 years, and I'm not prepared for that to happen to me. So a few weeks ago, we talked about golf course estates, and Sanjeev has written in to ask about that very thing, and he says, "Hi Margaret, what do you think of investing in Sandhurst Estates in Victoria? What would it be like? It grew very fast in the last few years, but seems to have stopped growing now. Could it be that a release of a lot of small blocks has saturated the market there, and whether it's likely that the growth will start again but at a much slower rate?" Sandhurst, you must be familiar with that, Ben. You're a Melbourne man.
I do, I am. A lot of vacant land out there, Margaret. Golf course estates, we know the research is in on those. If the lot is actually on the course, in other words, it sustains the view, just like the lakeside or the waterfront property, that property actually does do okay and holds value. As for the rest of the estate, it actually doesn't have a good result at all in terms of, you'll see the location next to the golf course outperform, and the other parts are just the fillers, and unfortunately they don't perform well at all. So that area in that area of town, Margaret, I'm not so thrilled about it with that vacant land out there, so it's a no-go for me.
Michael, typically the developers get hold of it, they sell it on lifestyle, but if an investor wants to buy there, it's probably not a good idea.
It's not a good idea, Margaret, and the thing about this particular estate and other estates like it is that we're seeing local government transfer the cost of services to these communities. So this type of estate is like a flat land strata, and so things like roads, parks, services to relating to garbage and post, they're being put back onto the community. Yet they're still charging rates, and so there's no relief from rates. They're getting whacked twice. So you end up paying the levies and the rates, and it's not good.
Generally doesn't grow well either, Sanjeev. I'd stay away from that one. If you're a pure investor, look for something that's a little more pedestrian, a little bit more easy to work out what the return's going to be, and easier to sell at the end of the day. Trent from the Gold Coast, welcome to the program, Trent.
Yeah, hi Margaret, how are you going?
I'm well, how are you?
Yeah, excellent. I've got a question in regards to an investment property that I'd like to invest into the Gold Coast area, specifically the Ashmore or Carrara area. I want to spend approximately $350,000 on a townhouse, and I just wanted to get your view and your opinions in regards to potential growth in that area in the next 5 to 10 years.
Trent, can you tell me, is this just a secondary sale, an established townhouse that you found there?
Established, yeah.
Great. I was just checking that it wasn't coming from one of those many spruikers selling townhouses on the Gold Coast at the moment. Michael, Ashmore.
Yes, look, I know Ashmore well. I've had an office in Ashmore for many, many years. I don't think so, Trent. I think the Gold Coast is one of those really problematic markets. It depends a lot on tourism. Tourism's not the big panacea for problems that we think sometimes it is. There's a lot of talk on the Gold Coast at the moment about the impact of the Commonwealth Games. I think that's laughable. I don't think it's going to have any impact at all. And I think the fact of the matter is you've got all those units that are mixed use along the strip, many of which are not occupied at all, can come onto the rental market at any time and distort the rental market. You've got the mega tower syndrome where big towers go up and the developer goes broke with 20% of the tower left, so they drop the price. Sorry to be very, very negative about the Gold Coast, but I've lived and breathed that market for 30 years, and very, very seldom do investors do that well on the Gold Coast. There's too many different things about the Gold Coast to make it a solid investment opportunity.
In addition to an ageing population, Ben, and I know a lot of commentators are currently calling it on the Gold Coast as being the bottom and saying there's some bargains to be had there, but even if it is the bottom, my opinion is you can sit on the bottom for a long time.
You can,
and it has.
Yeah, look, it definitely bottomed out. Or was it 2007, 2008 was its last hurrah, and that's in combined with the Japanese buy that was happening through Daikyo and all the groups that were coming into the tourism space. So I still think there will be some Asian investment into those types of markets. Sunshine Coast, Cairns is another one. But the big thing for me, Trent, is around that townhouse. If you are looking at it, it's got to be on title. It's really important that it has its own title. So the last thing I'd want to see, if you are still convinced that the Gold Coast is going to perform like you hope it would, is that make sure when you're buying these that they're on their own title, because at least you've got the land underneath you as opposed to having it as a strata, which from that point of view doesn't have the same type of return in the intrinsic value of the land. So
that's highly unlikely in the Gold Coast, Michael, isn't it? It's more like a townhouse on the Gold Coast on a Torrens title is
just not going to happen.
Not heard.
It's a Melbourne thing.
It's a Melbourne thing.
It's a Melbourne
We've
thing.
been buying them in Brisbane, so they are around. So
they must be new. I think you're going to find that certainly not many. Look, I tend to go with the panel on that. I think Ashmore wouldn't be where I'd invest. I've actually highlighted a couple of very small areas or defined areas on the Gold Coast that I think if you have to invest in the Gold Coast might go okay, namely suburbs like Helensvale and those suburbs that are closer up toward the southern suburbs of Brisbane. They're being pulled along by that whole Logan Shire growth, and because people can live there and either work in Brisbane or the Gold Coast, we're seeing some movement there. And I think if you have to invest in the Gold Coast, those border suburbs would be the only ones that I would really think about. And I certainly would go for a house and not, I definitely wouldn't go for a townhouse there, because it's the family demographic who is actually looking in those areas. Well, it's great to have your company this Monday night. And this week, if you call or email with a question that we answer, you will receive my ebook, How to Achieve Success in Property Negotiations. Now, it's a must-have if you're ready to buy. Call us right now on 1300 30 34 35 or email property@skynews.com.au with a question, and make sure you watch at the end of the show to find out how to claim your book. We'll be back to answer more of your questions right after we take this short break. Don't go away. Thanks for joining us this evening. Tonight on the panel and answering your calls is Ben Kingsley from Empower Wealth and Michael Tees from Block Strata. So why not give us a call on 1300 30 34 35 or send an email to property@skynews.com.au. Now remember, every caller or email answered tonight on the show will receive my ebook, How to Achieve Success in Property Negotiations. Next is an interesting question about rental yield, and it's from Dion, who asks, I'm just wondering what you believe an acceptable rental yield is when purchasing a property in an area where average growth is expected. Also, what are your thoughts on the property market in Mount Barker, South Australia? Ben, I find it interesting because it's difficult really to say average growth is expected. I love to know which crystal ball people are using when they say it's going to be good, bad or average. But
so I'll take a stab in the dark. Average growth is, capital growth is 4 to 5%. And then I'll say, if I'm looking at that, I'm probably thinking 5 to 6% yield is really what I'm sort of focusing on there. So if that's a balanced strategy, that's what I'm looking for in terms of recommending for property investment. If I'm going for higher growth, I usually shave off the yield a little bit. If I'm going for a capital growth area, and if I'm chasing a little bit higher yield, I shave down the capital growth a bit from that point.
Interesting way to look at it. How do you look at it, Michael?
Well, traditionally, I guess you'd say it's 3% net, 5% gross return on rent, and you let the capital gain takes care of itself. But if you look back over decades, you'd say it averages out pretty much as Ken suggested. So I think the interesting thing about the question is predicting average growth. Perhaps looking for something that is not got average growth is where Dion should be at.
You know, Dion, if you also look at the period of time that you're measuring growth over, I guess what Michael is trying to articulate is that if you look at 20 years or 30 years or say 40 years, then most properties are going to return a similar period of amount of growth over that period of time if you break it down into a year-by-year statistic. And most property is going to grow probably around about the 5% mark, and some years it'll grow 15 and 20, and other years it might grow not at all, but that's what an average growth amount would be. I guess my point was that it's difficult to predict ahead of time whether, or the amount that any market is going to grow by. It's easier to predict whether a market will grow by its growth drivers, but knowing how much, you just can't do that. So you can't say, I'm going to pick that market over that market because that one is going to grow better than that market. Nobody knows that. Past growth certainly isn't an indication of future growth. I'm going to come at this from a slightly different angle. You have to understand that all property has a different rental return, we already know that, but all property also has a different amount of depreciation and tax breaks available. And I much prefer to look at the after-tax return on any property that I'm going to buy. We can have two properties right side by side each other that will grow the same, that will get the same rental return, but one will have a better after-tax return than the other, depending on a number of things, but mostly the depreciation on that property. So I like investors to start thinking about after-tax return rather than try to go for these figures that probably don't mean a whole lot to you until you work out what it's going to cost you or what it's going to give you at the end of the day. As for Mount Barker in South Australia, I think there are better areas to invest, and I'd be inclined, if South Australia is your market, I'd be inclined to just look in Adelaide itself. There are some very good suburbs there to invest in right now that look like they have all of the hallmarks for a couple of good years of growth. John from Melbourne, how are you going, John?
Good, thank you, panel. I think just got a question, if you could help me. Just looking at investing in the city of Kingston around the Chelsea area. Just want to see your thoughts on that, because I just find in Melbourne, particularly where I live in the city of Manningham, it's gone up a lot because of the overseas buyers, and over there the growth hasn't happened like this area. So would that be a good area to invest in, or not?
Let's go straight to the man from Melbourne. A lot of Melbourne callers tonight. Ben, what have you done? Are they all your friends?
No, I don't know, John. Thanks for the call, though, John. And look, Chelsea is an interesting one. It's a flow-on from that Manningham sort of local government area. Remember that this, though, John, it's really important to understand that just because it's the flow-on doesn't guarantee that it's going to be an automatic wave rider. The things you've got to look for are still the fundamentals in terms of lifestyle drivers, proximity to the CBD, rail network, conveniences around that area. So if you are looking at Chelsea, I would also set your expectations in the lower side of the median value. So I don't know whether you're after a unit or a townhouse or a house. If you are after a house, then I'd be really focused on buying around the median, or maybe 5 to 10% below that, just from a compression risk point of view. What I mean there is, if the market is to soften, you're not going to have a correction in value. If you start chasing the next big fancy, Italian marble and all these types of things that are out there, you're not going to get that type of return, and you're going to pay a premium for the asset, and you're going to be sitting on it for 5 or 10 years with no growth. So if you are looking at that area, focus on the reliable and durable asset as opposed to the fancy bling.
Ben, Chelsea is an area where there's quite a lot of the family demographic. I should think that a unit or a townhouse would be a wrong property type choice anyway.
What's interesting about that area, Margaret, you're right in terms of the sort of mix of property, but what is good about it is that there isn't a lot of medium or high density stuff. So when you get that, you actually do get, there's still going to be nurses and still going to be people who want to move out of home. So you've actually still got a reasonable amount of appeal. If we started to see a lot more medium and high density stuff, then you're absolutely right.
Trouble.
Yep.
Yeah, oversupplied. Michael?
Yeah, Margaret, I just wanted to say to John about the Melbourne market, there is a lot of talk, and rightly so, about oversupply in Melbourne, but we need to be careful that we're talking about markets within markets. The oversupply is in units, and it's in the CBD and the South Bank areas. Figures out last week I was looking at that 17% of units in Docklands have no water bill, which means that they're just locked up. 17%. That's an enormous figure.
And growing.
Enormous figure. That's going to have an impact, a huge impact on stagnating capital growth in the unit market. So when we do talk about Melbourne at the moment, and people are talking in extremes for good reason, it's not, I think, about the houses in the types of markets you've just spoken about.
No, it's not. Although one of the cautions I would like to issue to you, John, is that it sounds to me like you already live in the neighbouring area, and now you're looking to invest in an area that you probably feel safe about because it's so close and you can watch it. But do be aware that when we do invest in property, we need to consider where we're already invested, and hopefully try to choose a market that may perform differently or at odds to the market that you're already in. You really want something in your portfolio to be growing all of the time, and if you load up your portfolio with only properties that are all in a single market or a single area, even if they're two side-by-side areas, they'll always be exposed to very similar rates of capital growth. If they're not growing, all of your properties will not be growing together, and if they are growing, that's great. I'd rather see you diversify a little. You don't necessarily have to diversify interstate yet because you don't have that many properties, or maybe you do, but at some point in time you'll need to look at diversifying interstate and start to pick and choose those markets so that you've got lots of different things happening at any one time in your portfolio, and that provides a little bit more safety to the bottom lines that you'll have. There should always then be something growing if you do that kind of diversification. Well, this is Your Money, Your Call, and although we are enjoying answering your questions, we do need to take a break. Now, it won't take long, so stay tuned, and perhaps even call us now on 1330 3435 or email us not at yourmoneyyourcall@destiny.com.au. Please ignore what's on your screen now. That's not correct. The correct address is property@skynews.com.au. We'll be right back. Welcome back and thanks for watching. I'm Margaret Lomas and with me tonight is Ben Kingsley from Empower Wealth and Mark Ortiz from Block Strata. Now we've had some really good questions tonight, but we do have time for more. So get to your phone now and dial 1300 30 34 35 or email us on property@skynews.com.au. Now remember, if we do answer your question tonight, you will receive a copy of my ebook, How to Achieve Success in Property Negotiations. Wayne, you're calling about Packenham, I believe.
Yeah, hi panel. I'm looking at buying some investment properties in Packenham. I just wanted to get your thoughts on that area.
Michael, I think Packenham was great about 7 years ago. But I don't know, it feels to me like it's still got a fair amount of land left, and you know, it's a decent drive into Melbourne. Not that that's a problem, because I'm feeling that the epicentre of Melbourne is moving out toward Narre Warren in terms of family demographic, lots of you know, blue collar workers, lots of industry out that way, and of course the Mornington Peninsula is easily accessible from there. Packenham's on the other side, sort of halfway between Narre Warren and out toward Warragul. What do you think?
It's interesting to look at this question in light of the debate at the moment about Sydney and Melbourne. You know, Melbourne, of course, is flat, and there are, well, it's relatively flat relative to Sydney, and it can go forever. It can go forever. So there is just land available that is not available to Sydney, and I think the geographic constrictions in Sydney of the the mountains, I guess they're mountains, the mountains, the national park, the harbour. Just makes it such a restricted landmass. It has a big impact, and I think this, you know, a lot of the press debate that we've been seeing in the last couple of weeks about supply and demand, and was it a case of negative gearing or is it not this? I think it is supply, and I think it is a lot to do with the way in which these cities are restricted. Melbourne has places, I'm not that familiar with Packenham, but it has places like Packenham and Werribee and other places where there's just lots of land and you can put lots of houses there. And you can't do that in another city. But
there's been a lot of broadacre development out there in Packenham. It's certainly become more part of Greater Melbourne, so people don't see it anymore as the cut lunch and a water bag bin that they used to see it as.
Still takes a while to get to town,
Still
Margaret.
can take a while, although there's the rail line, and it's quite an easy commute back into the city, with lots happening in Warragul, further afield down into Traralgon and Morwell, and even further down through into Sale and the Lakes entrance there. I think over time we will see some really good growth there, but I think it's going to be slow, at least in the next 5 to 10 years. When the broadacre lots were first released, a lot of people bought them. There was some really good values growth for a while, but it kind of overheated in its own little way, didn't it?
Yeah, and now we're seeing the flow-on effect of that, Margaret. And Wayne, this is a really important question. You make this decision and you get it wrong, it's going to stop you in terms of opportunity cost to move forward. So the reality of Packenham is, if you're going to look at that, you've got to look at the old established stock, and you've got to look at the new house and land packages, and the actual better return is in the old stock, not in the new stock. The new stock is going to drag up the old stock value, and that's where you're going to see. So don't be enticed by the marketeers, and if you're doing your research, don't just think automatically that population growth is a lay-down misere, that you're going to get growth in the value of assets. The reality is, in all greenfield estates and new areas where affordability is key, is the lower incomes of the people who live out there. So what pushes up prices is scarcity and the ability for people to be able to afford that. So you're going to think you're getting something good in terms of strong depreciation, but the reality is it's going to suffer from a development and an outperform result. So you're going to be flat growth.
Yeah. Look, they're doing some great things out there, certainly, but it's more really targeted to owner-occupiers at the moment who aren't so sweating on that capital growth. They're looking for lifestyle, and they're getting that in Packenham. It's a bit country, as in nice rolling green fields out there. The developers are certainly doing, you know, the nice little corner shopping centres with the petrol station and the car wash and the supermarket and everything that you need close by. But as for performing well as an investment, I think you need to leave it alone for now, and I think Ben's got some good points. So definitely, if you were going to buy there, I wouldn't buy two. I think you might have said a couple. I'd only buy one, and I'd go for that established stock. There'll be a big difference between the two of them. There's no builder profits built into that. You know what you're getting. You'll get a very similar rent return anyway, and if it's only a couple of years old, which it will be, because Packenham doesn't have a lot of real old houses, you'll find that there's still some good depreciation in those anyway. Jasmine's question next is about buyer's agents, and she asks, my question for the panel, I'm a property investor with one single property and an owner-occupier of my principal place of residence. I'd like to get into the market and purchase a second investment property in the next 12 months. I've seen advertised buyer's agents. What are the pros and cons of using a buyer's agent? I am concerned that they might inflate prices. Michael?
Look, I like buyer's agents. I think they're a really sensible idea. I think they're good for busy people. I think they're good for people that are not confident, and they're good for people that are not good at detail. I would use a buyer's agent. Now, be careful, Jasmine, the term is bandied about and it's misused. A buyer's agent is someone, in my opinion, who works on either a fixed fee or a commission fee, but for the purchaser, appointed by the purchaser, and is not selling stock that they have caused to be created or have any relationship at all with the vendor or the developer. That's the biggest question. So ask that of your buyer's agent. Are you absolutely independent? Am I the only person that's paying you? Are you getting anything from anyone else? If you get the right answers to those questions, then I think you can safely assume that the buyer's agent will deliver value for their money.
Ben, quickly.
I am a buyer's agent, and from that point of view, I'm a licensed real estate agent, so I work exclusively on behalf of the buyer. I have no stock lists, and that's exactly, Michael makes some great points there, Jasmine, around that. It's making sure that, you know, how are you paid? So we're fee for service, which is always a good way to go, so there's no hidden commissions or kickbacks or soft dollar payments. That's what you're looking for. So you're looking for someone who doesn't have an automatic stock list, in other words, doesn't diagnose you with something straight off the shelf. I just happened to find this one, and they brief you in terms of goals, outcomes, and they make sure they're appropriate for now and the future.
Now I'm going to just add a warning over that, Jasmine, and that is that a lot of people use a buyer's agent expecting that they're all just going to be able to also be property investment advisors, which few of them actually are. So make sure that if it's investing you want to do and you're going to use a buyer's agent, don't expect that every buyer's agent is going to be able to help you to work out where the best area is for you to be buying, because they won't. Many buyer's agents are great at the negotiation and will go and find a property for you, but they'll either work in a specific area themselves, which locks you into that area, or they'll only work in the area that you ask them to work in which case, if you're doing the research on the area in the first place, you might not necessarily want to also then pay a buyer's agent to do the buying for you, because you've already done all the hard work. Make no mistake, the hard work in buying an investment property is less about property choice and more about area choice. So you need to make sure that if you do use a buyer's agent, then you use one who can buy property for you anywhere in Australia, wherever it exists. And I wouldn't be doing my job if I didn't say that one of the other options for you could be to become educated yourself by doing a really good course, and therefore then you can buy on your own because you'll always know where to buy, and use a property investment advisor when you feel you need one. Rian from Balwyn, how are you going, Rian?
Yeah, hi Margaret, hi panel, hope all is well. I've got another question on Melbourne again. I bought a unit a few years ago in 2009 in Balwyn, in Victoria, and it was a two-bed unit, and it was for the mid-fives I bought it for, and the prices seem to have gone up over the last couple of years, especially with all the foreign buyers, and it's to a level now where it seems to be worth around the 900 kind of K mark. And I guess I'm confused as to whether it is worth selling it, a two-bedroom, given it is a two-bedroom unit, and trying to purchase kind of more 300-400K properties in more growth suburbs, or is it worth keeping it, given that, you know, we don't really want to be selling property if we can. I'm just keen to get your views around what your prospects are for Balwyn.
Rian, did you say that you live in the Balwyn property, or you don't?
I don't. It's rented out.
Okay, great. Ben. Interesting one. Balwyn is kind of on the fringe, but it is still being affected by some of that Melbourne oversupply, without question.
Balwyn's blue chip country, Margaret. It's actually just near Camboya, Hawthorn. It's a flow-on of that area. So, Rian, from my point of view, it's a buy-hold every day of the week. It's already shown you performance. It's an area that will always be under heavy demand from interstate and international buyers. It's proven that. It has Bourne High School, which is one of the best public high schools in the area. So if you're in that zone, you're going to see huge demand for rental in that particular area where families are trying to get in and they'll rent so they can get their child into Bourne High. It's a really important area. So for me, it's looking at using the equity, making sure your cash flows are good, and then replicating that, releasing that equity and keeping that, because at the end of the day when we retire, we want to live off that passive income. Why would we, I mean, if we bought it mid-5s and it's worth 900, there's a large capital gain event that could be occurring in there as well. So I would say hold and continue to build out, because one, it's it's going to keep growing in value, and two, it's going to have that rental income coming through.
Ben, I've got a quick question. Why is it always all about the schools for Melbourne people? Do you know what I find? When you meet a new person in Melbourne, you say, "Hi, I'm Margaret," and they go, I'm so-and-so, and they go, "Where do your kids go to school?" It's the first question. What's that about?
Quick story.
Is that a Sydney thing?
No, it's very much a Melbourne
thing, isn't it?
So here's a quick story. I acted for a fellow who was an architect who was born in Queensland, educated in Melbourne and in Sydney, and he said to me, Michael, he said, the wonderful thing about my background is that in Queensland the only thing that matters is where you were born. In Melbourne the only thing that matters is where you went to school, and in Sydney the only thing matters is that you're here.
And he's right.
It's really big, Margaret. Just to give you an example, at the moment, Mount Waverley, if you're one street away, it's the median difference is over $300,000 in one street. Now, those high schools can actually change their boundaries. It's not set in concrete. So if you've bought on that particular area, it can be an enormous amount. And obviously, these people are wanting to get their kids in, so new arrivals are wanting to get kids into the best school, as opposed to paying $30,000 a year for private school fees.
I must have just been a bad parent, because I just sort of...
Well, you are. There's no doubt about that. All your children will confirm that.
Any comment on Baldwin?
Look, I would say, I would echo Ben's comments that this is about, this has been a great investment for you. Why not keep it? Why not use the equity and do something, and perhaps do something out of Melbourne? Don't think that because you've had that great experience where you are, Melbourne units, as we've said earlier in the program, are very problematic. And I don't think any of us are certain what the flow-on effect is going to be of the massive oversupply in the city. It has to have a ripple effect on rental prices throughout the city, and so be careful about units, but certainly hold on to that property and use your equity to do something else.
Yeah, look, as the boys already alluded to, unrealised gain is worth so much more to you than realised gain. If you've made $400,000, just some quick sums, these aren't accurate, but you're going to pay capital gains tax on $200, gets tacked on the top of your marginal rate of tax, and if you're in the 45 cents in the dollar marginal rate of tax, you've lost nearly $100,000 to capital gains tax. Now that same $100,000 could be a deposit on a $500,000 property, or $500,000 worth of property elsewhere, and if you then start to snowball all of that, that's opportunity cost of $500,000 lost to capital gains tax, and then imagine what that $500,000 worth of property can do over a 10-year period when it grows. So I'm sure you're a smart enough person to work out all of that. Unrealised gain is worth more to you than realised gain, and unless you're in a falling market where you think you're going to lose your shirt, then I would never, ever sell a property that's done so well. Hang in there. You're obviously getting a very good rental return for your purchase price, and you've got all of that lovely equity sitting there waiting to leverage against to buy more property. Well, time's running out and we need to take one more quick break. But you might still be able to get your question answered if you hurry to the phone, and then you will receive a copy of my new ebook. Call now on 1300 30 34 35, or you can also email us on property@skynews.com.au.